Let's start with the basics. Everyone should have both stocks and real estate in their portfolios. Diversification is the ultimate hedge against risk. But that doesn't mean we can't compare the two in a classic Mortal Kombat style matchup. Which offers the best return on investment, real estate or stocks, and which investment is safer? Recent data, fortunately, is easier to find clear stock market data. Over the 45 years from January 78 to December 22, the S&P 500 averaged an impressive 11.53% return, including both dividend income and price gains. However, the stock market is known for its volatility, as anyone can see in a quick glance at the S&P 500 index chart. For reference, Treasury bills returned an average of 4.3% during the same period, and that's a risk-free product. The National Council of Real Estate Investment Fiduciaries, or NCREF, compiles the best data on real estate investments in the U.S. Their data includes over 35,000 privately owned commercial properties, from office buildings to apartment complexes to industrial properties and beyond, plus over 150 open and closed-end funds owning real estate. Over the same 45-year period, from January 78 through December 22, the NCREF Property Index, also known as NPI, has averaged an annual return of 9.03%. For additional context, the now REIT, all equity of publicly traded U.S. REITs, averaged 11.53% during the same period. The real question is, how does residential real estate stack up to commercial? Well, residential real estate performance, the data is a little less clear for residential. A report from the Real Estate Witch found that home prices have increased 7.6 times faster than income since 1965, showcasing just how well residential properties have performed in recent decades. But residential real estate returns include rental income, not just price growth. Unfortunately, there are few precious, reliable resources that include both income as well as their appreciation data. Nonetheless, fractional rental investing platform did a 20-year study in late 2021 that found that residential U.S. real estate returned an average of 11.7% with financing included. Removing the leverage, that number drops to 9.5%. Sources citing S&P's claim that the residential real estate averages a return of 10.6 over time. But I couldn't find the original data to verify that or even determine what time frame that figure refers to. You can see why the 145-year study is so valuable, given how unreliable other data on residential real estate returns are. Risk versus return. Now, how do you measure an investment's risk against its rate of return? It turns out that there's a simple way to determine the best return on investment. A literal risk-reward ratio. It's called the Sharpe Ratio, after its creator, William Sharpe. You start with an asset's return and subtract out the return of a short-term, risk-free alternative like U.S. T-bills. That gives you a risk premium, the extra return the asset delivers over a risk-free investment. And then you simply divide that risk premium over the asset's volatility as measured by its annual standard deviation in value. If the math gives you a headache, just think of it as a return divided by risk. A higher ratio indicates a better investment. Greater return on investment relative to the risk. Here's the breakdown. T-bonds, their Sharpe ratio is around 0.2%. It's weak sauce. Stock investments, not much better at 0.27. So their returns were strong, but they're more volatile than plutonium in a mad scientist's lab. Residential real estate has an average Sharpe ratio of 0.7%, which is great. In conclusion, residential real estate offers excellent returns with low volatility and huge tax advantages. But that doesn't mean there's no place for equities in your portfolio. Stocks provide liquidity, long-term growth, easy diversification across sectors and countries, and easy investing by tax-sheltered accounts such as IRAs or 401ks. Real estate provides stability, a hedge against inflation, ongoing high-income yields, built-in tax advantages, and diversification from the stock market. You invest well, rental real estate starts performing for you immediately. Equities take longer. But today you wouldn't produce significant income for at least 10, 20, 30 years from now. But the long-term returns will compound you at a prodigious rate, and a diverse portfolio protects you from crash in a single asset class or market segment. It's a lot on the plate today, but if you're in need of a real estate or experienced commercial real estate broker, I can be reached at 281-222-0433. Thanks for your time and have a good day.